That's right before the opening bell. A little bit of green for the Dow, the Nasdaq, and the S&P. Michael Lee joins us this morning. All right, Michael, are you buying bonds or stocks?
Well, a little bit of both. On the stock side, I continue to like these mega caps, the Magnificent Seven, and a lot of attention's been placed on the fact that you have these 7 names that are driving the market this year. Well, if you take a step back and think about it, in a rising interest rate, slowing economy type environment, which companies do the best? Those with the strongest balance sheets and the most secure business models. And so if you think about an Apple, you think about a Meta, formerly known as Facebook, these companies are like massive castles with enormous moats around their business. They also have the strongest balance sheets, and they have some catalysts going forward. For Meta, it's dropping this metaverse, cutting costs, and revenue growing at over 20% while having a mid-teens multiple. And on Apple, it's Apple services. So what you pay for in the App Store, the subscriptions you have, Apple Care, Apple Pay, that's $1 trillion valuation business, if not more. And then as the economy slows, you want to buy bonds.
So these safe stocks are these mega cap stocks, the Apples of this world, the Microsofts. They're safe, right?
Yeah, well, Stuart, and it seems ironic because for so long and so much of our careers, these have been the go-go growth names. But now they've almost transformed into the defensive names because they're sitting on piles of cash. They have extremely secure businesses, almost anti-competitive, monopolistic type businesses that regardless of that as the economy slows, it's going to be harder for competition to come in and take market share away from them. So these are the most secure places as equity investments in the market. And then I think interest rates on the long-term bonds got sold off way too much. Stanley Druckenmiller out there last week saying he's going to buy as many, 10-year and 30-year bonds as he can because he thinks those were oversold. And as we go into a recession, we know that bonds with the greatest duration or the greatest interest rate sensitivity do the most. So I also like TLT, which is the ETF for the long-term Treasury bonds.
Okay, we hear you. Mike Lee, thanks very much indeed. David Barneson, safety in the